Margaret retired at 67. 41 years as a registered nurse in Ohio, she had $420,000 in a traditional IRA, $1,100 a month in Social Security, and a small pension from the hospital system she gave her career to. Her financial advisor told her the Medicare Part D premium was just a fixed cost, nothing you can do about it. So Margaret paid it, every year, without question. Then she got a letter from Medicare in January 2026. Her Part D out-of-pocket drug costs had hit $3,800 before she even reached summer. On a fixed income. Margaret had no idea the Senate had just passed a bill that put a hard cap on exactly that number. She had no idea it applied to her. And the enrollment window to adjust her coverage had already closed. Nobody told her. Margaret is not unusual. She is what happens when a retired Medicare enrollee does not know about the ElderCare Protection Bill, what it actually changes, what it caps, and what it requires you to do to claim it. If you are on Medicare, drawing Social Security, or making any decisions right now about long-term care, you are exposed. Not your neighbor, not someone else, you. This bill touches your drug costs, your Social Security check, your nursing home options, your tax return, and the caregiver benefits your family is walking away from every single year. Today, I am going to show you 6 specific things this law changes, and the exact dollar amount each one costs you if you don't act on it. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Frank Dalton. I spent 35 years as a CPA working with retirees before I stepped back from the practice. Every week on this channel, I break down the tax rules, the IRS traps, and the strategies that protect retirees from the things your advisor never mentioned. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me get into it. Number 6. The drug cost cap and what it does to your Medicare premium. Let me start with the one getting the most attention, the Part D out-of-pocket cap. The Senate's bill puts a hard ceiling on what Medicare Part D enrollees pay in drug costs in a single calendar year. For 2026, that number is $2,000. Once you hit it, Medicare covers the rest. No exceptions, no fine print on that ceiling. If you are currently spending $300 or $400 a month on prescriptions for diabetes, heart disease, or arthritis, which millions of retirees are, this cap is real money. Take Robert, he's 71, retired teacher in Florida. $52,000 a year in combined income from Social Security and a small IRA withdrawal. He was paying $3,400 a year in Part D costs before this bill. Under the $2,000 cap, Robert saves $1,400 every single year. Let me put a dollar amount on this so you understand the stakes. $100 to $400 per year. Over 15 years of retirement, that is $21,000. That is not a rounding error. That is a real number. But here is what nobody is telling you about this cap. And this is the part that matters if you have a traditional IRA. The cap does not protect you from IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It is the surcharge Medicare adds to your Part B and Part D premiums the moment your income crosses certain thresholds. For 2026, the first IRMAA tier kicks in at $103,000 for a single filer. $1 over that line, and your Part B premium jumps by roughly $70 a month. That is $840 a year for nothing. The money you save under the drug cap does not reduce your IRMAA exposure, but the size of your IRA withdrawal does. If you are taking large distributions from a traditional IRA to cover living expenses, and those distributions are pushing you close to an IRMAA threshold, you need to be looking at this right now, not the year you cross it. The time to manage that balance is before your required minimum distributions force the issue. The cap is real, take it, but watch the bracket it creates while you do. Number 5. The Social Security COLA fix and the tax bill nobody sees coming for decades. Your annual Social Security cost of living adjustment has been calculated using an inflation formula designed to track the spending habits of urban working-age employees, people buying gasoline for a commute, paying for job-related expenses, not people in their 70s spending a disproportionate share of their income on prescriptions, home health aides, and medical appointments. The result, the COLA has been systematically underestimating real inflation for retirees for years. The bill pushes for the adoption of a senior-specific inflation index, one calibrated to what people over 62 actually spend money on: healthcare, housing, in-home assistance. These categories inflate faster than the general index. A more accurate index means larger COLA adjustments every single year. Take Dorothy. She is 74, widowed, living in Tennessee on $22,000 a year from Social Security. Under the corrected index, her annual COLA increase would be approximately $340 more per year than under the current formula. Let me put a dollar amount on this. $340 more per year, compounding on top of Dorothy's base benefit over 20 years, adds up to more than $8,500 in cumulative additional income. That is real money for someone on a fixed budget. Here's what nobody mentions when they talk about a bigger Social Security check. More Social Security income means more of your benefit becomes taxable. Right now, up to 85% of your benefit is taxable if your combined income, that is your adjusted gross income, plus non-taxable interest, plus half of your Social Security exceeds $34,000 as a single filer or $44,000 as a married couple. These thresholds have not been adjusted for inflation since 1984. They were never indexed. That means more retirees cross them every year, even when their real purchasing power is flat. Dorothy's $340 gain could result in $85 to $145 in additional federal income tax, depending on how much of her benefit is already in the taxable zone. That does not cancel out the gain, but it reduces it, and most retirees have no idea this happens until the bill arrives in April. A bigger COLA check is good news. Just know what the IRS does with it. Number 4. Nursing home reform and the spend-down trap. Nobody explains. The bill mandates minimum staffing ratios at Medicare and Medicaid-funded nursing facilities. It dramatically increases financial penalties for safety violations. It requires full public disclosure of inspection records and staffing histories. These are meaningful reforms. But from a tax and financial planning standpoint, there is a trap buried inside nursing home planning that this legislation does not touch. And it is destroying the retirement savings of families all over this country. Take Gerald. He is 78, retired engineer in Pennsylvania. He has $380,000 in savings, a home worth $290,000. His wife was admitted to a memory care facility last year at $9,200 per month. Let me put a dollar amount on this. Gerald is paying $110,400 per year for his wife's care. Under Pennsylvania's Medicaid rules, their joint assets must be drawn down to approximately $148,620 before she qualifies for Medicaid coverage. At $110,400 per year, they burn through their savings in less than 2 years. And every IRA dollar Gerald liquidates during that period is fully taxable income. In the exact years he can least afford a large tax bill. Here is what most retirees don't know. Nursing home costs are deductible as a medical expense on Schedule A, but only to the extent they exceed 7.5% of your adjusted gross income. If Gerald's AGI is $60,000, the first $4,500 of medical expenses are not deductible. On $110,400 in nursing home costs, the excess deduction is substantial. It exists. It is real. Most families never take it because nobody told them. The new oversight rules in this bill make nursing homes more accountable. That matters for quality of care. But the financial devastation of spend down has not changed. That is a problem you have to solve before the crisis hits, not while you are in the middle of it. Number 3. Elder fraud protections and the IRS rule. most victims never use. The bill creates dedicated federal funding for elder fraud investigation and prosecution. It requires banks and credit unions to flag suspicious activity in senior accounts and put protocols in place before the money is gone. It funds public education campaigns. These are important steps. But here is the IRS angle that no one in this space is talking about. Take Helen. She is 73, retired bookkeeper in Arizona. She lost $34,000 to a grandparent scam, a phone call, a fake emergency, wire transfers she could not reverse. Devastating. The IRS has a provision called the theft loss deduction. Under the Tax Cuts and Jobs Act of 2017, personal theft losses are generally not deductible, but there is a carved-out exception for fraud losses in transactions entered into for profit. And the IRS published Revenue Procedure 2009-20 specifically to address Ponzi scheme and fraudulent investment losses. If the fraud involved what the IRS considers an investment-related scheme, Helen may qualify to deduct a meaningful portion of her loss. Let me put a dollar amount on this. Helen lost $34,000. If she qualifies under Reverend Procker 2009-20, she may be eligible to deduct 75% of her loss. If she is not pursuing a lawsuit, that is $2,500. In the 22% federal bracket, that is $5,610 back on her return. Her accountant never found it. She never filed it. The new fraud protections in this bill will help future victims. But if you or someone you know has already been targeted, the IRS has rules on the books right now. You need a CPA who knows they exist. Number 2, the caregiver tax credit, money. Most families are walking away from the bill, creates expanded tax credits for family caregivers, adults who are spending their own income on the care of an aging parent, spouse, or family member at home. We are talking about direct care costs, home health aides, adult day programs, medical equipment, medically necessary home modifications. Take James. He is 58, project manager in Georgia. He is supporting his 82-year-old mother at home. He pays $14,000 per year in direct out-of-pocket care costs. Here is the difference between a deduction and a credit, and this matters. A deduction reduces your taxable income. A credit reduces your actual tax bill dollar for dollar. These are not the same thing. Let me put a dollar amount on this. James earns $95,000 per year. A $3,500 medical expense deduction in his bracket saves him roughly $770. A $3,500 direct tax credit saves him $3,500. And this credit does not require him to itemize. It is available even if he takes the standard deduction. Here is what most caregiving families don't know. Existing IRS rules, the dependent care credit, the ability to claim an elderly parent as a dependent, the medical expense deduction (NE) are already on the books right now. Not after this bill is fully implemented. Today. If you are financially supporting a parent or family member, there is a real possibility that some of what you are spending is already deductible, and you are filing without it every single year. The caregiver credit in this bill adds another layer, but the foundation is already there for people who know to look. Number 1. The dental, vision, and hearing gap. A Medicare problem and a tax problem. This is number 1 because it is the most universally ignored. Original Medicare, Part A and Part B, does not cover routine dental care, routine vision exams, or hearing aids. The bill makes real progress here. Subsidies for hearing aids, expanded dental access through federally qualified health centers, pilot programs for vision care. Meaningful steps, but the gap is still significant. And the out-of-pocket costs filling that gap have a direct, immediate connection to your federal tax return that almost no one is using. Take Carol. She is 69. Retired school administrator in North Carolina. She needs 2 hearing aids at $5,800, a dental implant at $4,200, annual vision exams and glasses at $600. Total out of pocket this year, $10,600. Let me put a dollar amount on this. Carol's AGI is $48,000. The 7.5% medical expense floor is $3,600. That means she can deduct $7,000 of that $10,600 on Schedule A. In the 22% bracket, that is $1,540 back on her return, but she has to itemize to get it. Here is what most retirees don't know. Dental implants are a deductible medical expense. Hearing aids are deductible. Prescription glasses are deductible. Medically necessary home modifications for conditions like mobility impairment, deductible. Long-term care insurance premiums, partially deductible on an age-based sliding scale. LASIK surgery, deductible. Transportation costs to and from medical appointments, deductible. Most retirees with significant out-of-pocket healthcare costs are taking the standard deduction and walking away from hundreds or thousands of dollars every single year. The bill narrows the coverage gap, but the tax deduction for what you are already paying has been sitting in the code for years, unclaimed. Let me give you a real example of how all of this plays out in a single household. Take Richard and Susan, both 71. Richard collects $28,000 a year in Social Security. Susan collects $16,000. Richard takes $22,000 a year in IRA distributions to cover living expenses. They have $310,000 remaining in traditional IRA assets. They live in Georgia. Total household income, $66,000. In their current situation, before any planning around this new bill, here is what their year looks like. They are paying $4,100 in Part D drug costs annually. Their Social Security COLA came in at 2.5% this year, but their actual healthcare costs inflated closer to 4.8%. They spent $8,400 out of pocket on dental, vision, and hearing that Medicare did not cover. Richard's sister is acting as a family caregiver for their mother and spending $11,000 a year in costs she does not know she can credit. And last year, Susan was targeted by a phone scam and lost $6,200. They filed standard deduction. The theft loss was never reported. Now let's recalculate with everything on the table. Under the new $2,000 Part D cap, they save $20,100 in drug costs immediately. With itemized medical expenses, the $8,400 in uncovered dental, vision, and hearing, they exceed the 7.5% AGI floor by $3,550. In their bracket, that is $759 back. Susan's scam loss, if it qualifies under Revenue Procedure 2009-20, could generate a deduction of $4,650, worth another $1,023 in federal tax savings. Richard's sister, with proper tax planning, accesses $3,500 in caregiver credit. Total difference in 1 year for one household, over $3,800 in combined savings and tax recovery. On the exact same income. That is not a loophole. That is not a strategy only the wealthy can use. That is the law working exactly the way it was designed to work, for people who know how to read it. Let me bring it all together. Here are all 6 in order. 1. The Part D drug cost cap is real and it saves real money, but it interacts with your IRMAA threshold, and an IRA withdrawal strategy can make or break that. 2. The Social Security COLA fix gives you a larger annual check, but a larger check makes more of your benefit taxable, and most retirees are not accounting for that on their return. 3. Nursing home reform improves facility standards, but the Medicaid spend-down trap and the medical expense deduction are your financial lifelines, and most families facing a care crisis are not using either one. 4. The elder fraud protections are stronger, but IRS Revenue Procedure 2009-20 exists right now, and most fraud victims are not filing it. 5. The caregiver tax credit is new money, but existing dependent care rules and medical expense deductions are already on the books, and most caregiving families are leaving them unclaimed every single year. 6. The dental, vision, and hearing gap is narrowing, but the medical expense deduction already covers a large share of what you are paying out of pocket, and most retirees are taking the standard deduction and walking away from it. 6 things this law changes. 6 places where the tax code already protects you. Most retirees know 0 of them on the day they retire, and every single one you miss costs you money. This is Frank Dalton. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you're not subscribed yet, hit subscribe and turn on the bell so you don't miss the next one. The video I'm working on next breaks down the single most dangerous RMD mistake retirees are making in 2026, and most people don't catch it until after they've already triggered the penalty. You need to see it before your first distribution deadline this year. And if you know someone who is on Medicare, drawing Social Security, or supporting an aging parent right now, send them this video today, not tomorrow, today, because enrollment windows do not wait, and neither does the IRS. Drop a comment below. Tell me, did you know the medical expense deduction covered hearing aids, dental implants, and glasses? I read every single comment, and the most common situations become future videos. I'll see you in the next one.